Just as a heads up, the myth that we have to build affordable housing is just that, okay? That's a myth. No offense. I mean, like the average consumer, like the average worker is dumb. But if you're, God, dude, I don't want to have to defend fucking crypto shitters. I know I'm right. God damn it. I'm so fucking right. Vosh is never going to go public with it because he knows that I called it.
And then my other crypto account can buy that NFT. And now that NFT is worth $1 million. I get to say I've made $1 million. Here's how I made it. Great. No.
Dan is like, oh, well, let me tell you. I have a picture of a monkey and I sold that for $5 million. I'm sorry. I understand what you're saying. I understand.
I feel like you don't understand, and it makes me sad.
No, I understand. You're just like, stop stalling and give us the okay, I'm starting it.
For online content creators, the unavoidable subject of 2021 has been NFTs, from incredibly cringeworthy ape profile pics to incomprehensibly tasteless tributes to deceased celebrities to six-figure sales of the original copy of a meme. It is the thing that is currently dominating the collective brain space of digital artists and sucking up all the oxygen in the room. And I do want to talk about that. I want to talk about my opinions on NFTs and digital ownership and scarcity and all the myriad dimensions of the issue, but I don't just want to talk about NFTs. I can't just talk about NFTs because ultimately they are just a symbol of so much more, and it is that more that is ultimately important. So let me tell you a story. In 2008, the economy functionally collapsed. The basic chain reaction was this. Banks came up with a thing called a mortgage-backed security, a financial instrument that could be traded or collected that was based on a bundle of thousands of individual mortgages. Based on the general reluctance...
I feel like there was a, God, what was it? It was during the GME thing when every single video started out with like, this is what a short sale is. I feel like I heard this thing a million. I feel like I hear similar things. People talk about 2008, 2007, like, this is a mortgage-backed security. This is a CDO. Well, and it's like the same every time.
Of banks to issue mortgages, the risk aversion in lending someone hundreds of thousands of dollars that they'll pay off over the course of potentially decades, these bonds were seen as especially stable. However, they were also immensely profitable for the banks who both issue the mortgages and the bonds. Because of that perceived stability, a lot of other financial organizations like pension funds and hedge funds use them as the backbone of their investment portfolio. In this arrangement, a mortgage becomes more profitable to the bank issuing the mortgage as a component of a bond than it is as a mortgage. Proportionally, the returns per mortgage from the bond are just that much better than the returns from the isolated mortgage. There's some problems though. Problem one is that the biggest returns on a bond come from when it first hits the market. A new bond that creates new securities sales is worth more than an old bond that is slowly appreciating, but not seeing much trade. Problem two is that there are a finite number of people and houses in America. The market has to level out at a natural ceiling, as eventually all or nearly all mortgages are packaged into bonds, thus very few new bonds can be generated and sold. So here's the incentives that are created. 1. It's good for banks if there are more houses that they can issue mortgages for. 2. The more mortgages issued, the better, because a bad mortgage is worth more as a component of a bond than a good mortgage that's not part of a bond. So real estate developers find that they have a really easy time getting funding from banks for creating vast new suburbs full of houses that can be sold to generate mortgages, but rather than building the kind of housing that most people actually need and want, they focus specifically on the kinds of upper middle class houses that fit into the sweet spot from the perspective of the banks packaging the bonds. Buyers in...
Just as a heads up, I don't expect this guy to know this or care about this or whatever, okay? But the myth that we have to build affordable housing is just that, okay? That's a myth, okay? We can build all sorts of housing. Any housing is good. Upper middle class, whatever the fuck housing, all of it is good, okay? All housing is good. The idea that we can only build some types of housing, okay, is a bullshit meme. Wait, why can't I resize this? Oh God, whatever.
In turn, find that they have a suspiciously easy time getting a mortgage, despite the fact that for most people, the economy wasn't doing so great. Wages were stagnant, and yet even though developers were going absolutely haywire building new houses,
Why? Because there's a transfer effect that happens. If I go to some area and it's like, wow, these apartments are really unaffordable, what are we gonna do? Let's just build a fuck ton of luxury condos, right? Well, people are like, well, we need affordable housing, not luxury condos. Well, when you build all those really expensive condos, all the wealthy people will move into those, and then hopefully you free up some housing stock in like the middle or lower expense units or whatever. It's essentially what happens. Whether you build affordable housing or whether you build upper class housing, it doesn't matter, because it is not an economics problem, okay? It's not even a physics problem, it's just a math problem, okay? Number of people that want houses is X, number of housing units available is Y. You have to build more Y. It doesn't matter what the fuck you make. You just have to build something, whatever you do. So if building affordable housing is what you want to do, then fucking knock yourself out, go for it. If it makes you feel better, just build something. If it's between luxury condos or nothing, build the luxury condos. It'll help, all right? Just build something, okay? Just get more units out there, okay? Something.
housing, the houses being built were all out of their price range to begin with.
Isn't it less expensive to make higher price housing, therefore less can be made? No, okay? Housing is one of the few things that the free market will solve for incredibly well. If you zone whatever the fuck you want to zone in a major city, somebody will step up to build there because there's always money to be made there. I don't know if I have exact data for this, but I don't know, Dan would know, but like I'm almost positive that I'm right intuitively, that like housing, the cost of housing is not the housing. Nobody gives a fuck about like the actual housing. It's just it's the land. That's the most important part. So if you get zoned for something, somebody will come and build it because who the fuck cares like the cost of the whatever. The important thing is actually having land to build on. You can zone it for whatever the fuck you want, just so that you can build high rises, apartments, houses. Like people will build there. It will happen. You don't need like incentives or any crazy shit to do it. Okay.
And counterintuitively, this massive increase in supply wasn't driving down the price. This is because the houses were being bought just mostly not by people intending to live in them. They were being bought by speculators who would then maybe rent them out or often just leave them vacant with the intent to sell a couple years later. Because speculators were buying up the supply, it created synthetic demand. The price keeps going up because...
Fuck, I don't know if this is true. Fuck, and I don't trust this. I don't know who this guy is. Is Dan still here? The type of loan that you can qualify for as a speculator is going to be a bit different than the type of loan you qualify for if it's your primary residence. Too late, you missed your chance. If you're like somebody that's buying a house for the first time, there are special programs available for you that enable you to buy a house easier than most people. So like FHA loans, for instance. I don't believe you can't get FHA loan on a house you're going to use as a rental property. I don't think that the big demand
you can, but you have to live in one of the units.
Okay. You can't. Okay, yes, there are loopholes that you can kind of use maybe to do it, but like you can't like FHA loan, buy a big house and then rent that house to somebody. Maybe with like a multi-unit thing, if you live in one of the units, maybe you can. I thought that one of the big problems with the housing crisis is that it was driven by people getting houses. It wasn't just speculators or investors with the money to put down. It was people that genuinely couldn't afford it. But the banks basically stopped verifying your income, or they did very weak verification on like assets. And then what happened was people got into houses they couldn't afford with the assumption that they would increase in cost. And then when they stopped, then everybody got fucked. I didn't think the failure was on big like institutional investors or whatever. It was just individuals buying homes that they probably couldn't afford. I don't know how I would quantify this or get numbers on this, but. Did I turn this on?
Because speculators keep buying, which creates the illusion that the value is going up.
He gets into that? Yeah, maybe. I'm so scared about ideological like poisoning of my videos that like I don't know if this part of the video he's putting out here to shit on like the rich capitalists are the real reasons why society failed, because he really doesn't want to blame homeowners or some shit. Or maybe he's not. Maybe I'm being unfair and I'm jumping to conclusions. Maybe it's not like that at all. We'll see.
Which attracts more speculators who buy up more supply and further inflate the price. These speculators are enabled by a system that is prioritizing generating new mortgages purely for the sake of having more mortgages to package into bonds. The down payments are low and the mortgages all have a really attractive teaser rate, meaning that for the first 3 to 7 years of the mortgage, the monthly payments are rock bottom, as low as a few $100s per month against a mortgage that would normally charge thousands. Caught up in all this are legitimate buyers who have been lured into signing for a mortgage that they can't afford by aggressive salespeople who have an incentive to generate mortgages that they can then sell to a bank, who can put it into a bond to sell to pension funds to make a line go up because it's good when the line goes up. It's a bubble. The bubble burst as the teaser rates on the mortgages started to expire. The monthly cost jumped up, and since the demand was synthetic, there were no actual buyers for the speculators to sell the houses to. So the speculators start dumping stock, which finally drives prices down, but because the original speculators, their mortgages started to expire. It's a bubble. The bubble burst as the teaser rates on the mortgages started to expire. The monthly cost jumped up, and since the demand was synthetic, there were no actual buyers for the speculators to sell the houses to. So the speculators start dumping stock, which finally drives prices down, but because the original price was so inflated, the new price is still out of reach of most actual buyers. Legitimate buyers caught in the middle find their rates jumping too, but because the price of the house is going down as speculators try and dump their stock, the price of the house goes down relative to the mortgage issued, and thus they can't refinance and are locked into paying the original terms. Unable to sell the house and unable to afford the monthly payment.
Fuck. I don't like the way that this is phrased. Maybe I don't care. I have autism. I don't care, dude. I'm not sure. Okay.
The owners, legitimate and speculators, default on their mortgages.
The price of your house going down, the cost of your house, the value of your house going down has zero impact on your ability to pay the mortgage. Like, yeah, you're not getting equity in the house, or you might even have negative equity. But like that idea that like because the value went down, they couldn't refinance. If refinancing is part of your home buying strategy, don't fucking buy a home. You could never afford it in the first place. Okay, that sentence doesn't make sense. Like, well, they couldn't afford their mortgage payments anymore because they no longer had the ability to refinance. Why the fuck do you need to refinance to afford your fucking mortgage? Also, if you're buying an ARM, if you're getting an adjustable rate mortgage, and your goal is to like always have the teaser, you also could never afford it. Like, but it does on your ability to refinance, which is what a lot of people are expecting to do because of teasers. Yeah, then you're dumb as fuck, Rage Pope. I'm sorry, but you're. No offense. I mean, like the average consumer, like the average worker, is dumb. But if you're getting an adjustable rate mortgage with the dream of one day being able to like refinance, because once the teaser rate expires, you're not gonna be able to afford the monthly payment. You could never afford that. You were never affording that. You were never able to afford the home in the first place. You shouldn't have bought it. But I understand that there were incentives at the time that were misaligned with the banks and everything. But sorry. Okay.
They stop paying. Eventually, the default rate reaches criticality and the bonds fail. As the bonds fail, this impacts all the first order buyers of the bonds, hedge funds, pension funds, retirement savings funds, and the like. It also cascades through all derivatives, which are financial products that take their value directly from the value of the bond. This creates a knock-on effect. Huge segments of the economy turn out to be dead trees, rotten to the core, but as a rotten tree falls, it still shreds its neighbors and crushes anything below it. It was a failure precipitated by a combination of greed, active fraud, and willful blindness at all levels of power. The banks issuing the bad mortgages were the same banks selling the bonds and providing the capital to build the houses to generate the mortgages. The ratings agencies checking the bonds were themselves publicly traded and dependent on being in good relations with the banks, incentivized to rubber stamp whatever rating would make their client happy. The regulatory agencies that should have seen the problem coming were...
Are you just upset that he's not blaming the people who bought the mortgage? It seems pretty accurate. It's just like... I feel like everybody, when it comes time to analyze a situation, can only play into their lens. The reality is everything he's saying is correct. There were bad, like, the bank's incentives here were perverse. The credit rating agencies probably did fuck up when they were rating some of these bonds. This whole incentive structure was probably bad, but people also bought homes that they couldn't afford. Like, consumers were dumb as fuck as well. Now, if you want to preface this by saying, and you know what, I probably would. I would say, you know what, I'm not going to blame consumers at all because I expect consumers to be literal brain-dead monkey apes that respond so incredibly predictably to financial incentives that if I were to pay them enough money, they would sell me their fucking children's kidneys. Then sure, that's fine. That's probably true. But it just, to not bring that up at all and to make it sound like, oh, the only people who did anything wrong, like it was just a bunch of poor homeowners, poor buyers. No, they were people looking to get rich quick which was a lot of them, to get their first home that they couldn't rightfully afford, which was a lot of them, and they got caught in the middle of a bubble with their pants down, and they got fucked by the bubble pop as well. Now, we can say that we expect the average consumer to be a dumb fuck, which is fine. Again, I'll do that. But to totally leave that out, like they were like, is a little like they had a lot. They stood to gain a lot as well from this whole fucking crisis, just as much as the banks and everybody else did. Maybe the banks and everything are leveraged to gain more, but still. Okay. Anyway, continuing on.
Gutted by budget cuts and mired in conflicts of interest as employees use their positions in regulation to secure higher paying jobs in industry. And, the cherry on top, the people largely responsible for it all knew that because they and their toxic products were so interwoven into the foundations of the economy, they could count on a bailout from the government because no matter how rotten they were very large trees.
I don't know if I believe that. If there were leaked documents or something showing otherwise, I might. But the idea that I think this borders into conspiracy. The idea that like they're having this conversation, and I'm sure there was probably some fucking movie where they said this, or they might even said in that one Big Short movie or whatever, which I still haven't watched. But the thing where like, okay, well we can just fuck everybody over and it's okay because we know we're gonna get a bailout at the end. What about Lehman Brothers? They didn't get a fucking bailout. Okay. Was it wait, isn't that called The Big Short? Whatever.
This naked display of greed and fraud created what would be fertile soil for both anti-capitalist movements and hyper-capitalist movements, both groups of people who saw themselves as being screwed over by the system, with one group diagnosing the problem as the system's inherently corrupt and corrupting incentives, and the other seeing the crisis as a consequence of too much regulation, too much exclusion. The hyper-capitalist or anarcho-capitalist...
The problem is that it was rational for most speculators to speculate. Just because there's a crash doesn't mean you shouldn't speculate. It just means you need to get out before the crash. 30-1. Yes, that is true. And that's part of the issue with perverse incentives existing like this in this environment, is because my understanding is that if you were a good and responsible bank and you did your best to only loan out responsibly, you got fucked because nobody's going to you for a fucking mortgage when your rates and everything are more strict than the guy down the street. And now you have to make a decision as a business owner. Do I want my employees to get fucked? Do I want my shareholders to get fucked or the owners of my business? Because now you have to compete with all the people that are issuing the bullshit loans. And if you don't do it, your customers are going to feel like you're fucking them over. Like, why are you giving me these rates and these terms when I can get like, I don't want a fucking conventional conforming mortgage when the people down the street are offering me these really sexy adjustable rate mortgages, these 15, 20, 30-year adjustable rates or whatever. Why the fuck would I take this stupid boring ass mortgage? Like, why won't you do anything, right? Your customers feel fucked, your employees get fucked as you lose business, your owners get fucked as you lose money. When you have these environments set up with all these perverse incentives, everybody is like kind of bought into having to act in the most irrational way possible. Because the irrational way is the way that's irrational in the long term is actually hyper rational in the short term. Yes. But
argument is that in a less constrained market, there would be more incentive to call foul, that regulation had only succeeded in creating an in-group that was effectively able to conspire without competition. Of course, this argument fails to consider that a substantial number of people within the system did, in fact, get fabulously wealthy specifically.
How did we fix that issue? Rage would tell me if this went away or if this was, but I think it was the idea that like if you're selling like mortgage products to people, you can't be an investment bank at the same time. You have to pick what your role is going to be. You can't do both. So if you're going to sell mortgages, you can't sell mortgage-backed securities to like investment banks. You have to pick one role and you've got to do that one thing.
Specifically by betting against the synthetic cess of the market, but regardless. Into this environment in 2009 arrived Bitcoin, an all-electronic peer-to-peer currency. Philosophically, Bitcoin and cryptocurrency in general was paraded as an end to banks and centralized currency. This is what will form the bedrock, both philosophical and technological, that NFTs will be built on top of. It's a bit of a hike from here to the Bored Ape Yacht Club, so I guess get ready for that. Strap in. As we get into this, we're going to have to deal with a lot of vocabulary, need to deal with a lot of complexity. Some of this is the result of systems that are very technically intricate, and some of this is from systems that are poorly designed or deliberately obtuse in order to make them difficult to understand and thus appear more legitimate. The entire subject sits at the intersection of two fields that are notoriously prone to hype-based obfuscation: computer tech and finance, and inherits a lot of bad habits from both, with a reputation for making things deliberately more difficult to understand, specifically to create the illusion that only they are smart enough to understand it. Mining and minting are both methods of making tokens, which are the base thing that blockchain...
Okay, finance is legitimately difficult to understand, and when we try to simplify the fuck out of it so that the average fucking normie can understand it, then they fuck themselves over. See GME and AMC, and see fucking no fee trading, no transaction cost trading, where everybody could be a trader and everybody could be a pro, blah blah blah. Okay, and it's the same thing with computer shit too. These things are relatively complicated for a reason, and it is difficult for a reason, not because they're just trying to keep people out, but because there's a lot of things to consider when you're acting in any of these fields.
Deal with, but the two are colloquially different processes, where mining is a coin token created as a result of the consensus protocol, and minting is user-initiated addition of a
Destiny, is he saying the opposite? He's saying that, like, these fields are prone to people making them sound harder than they actually are, just to, like, I don't know, be like gatekeeper or whatever. That was the impression that I got. You can say I had the wrong impression, but if we go back and listen to it and I got the right impression, I'm banning you for making me go back.
Token to a blockchain. All blockchains are made of nodes, and these nodes can be watcher nodes, miner nodes, or validator nodes, though most miner nodes are also validator nodes. Fractionalization is the process of taking one asset and creating a new asset that represents portions of the original. So you get Dog, a meme coin crypto DeFi venture capital fund backed by the fractionalization of the original Doge meme sold as an NFT to Pleaser DAO on the Ethereum network. I'm sorry, some of this is just gonna be like that. The idea behind cryptocurrency is that your digital wallet functions the same as a bank account. There's no need for a bank to hold and process your transactions, because rather than holding a sum that conceptually represents physical currency, the crypto coins in your crypto wallet are the actual money. And because this money isn't issued by a government, it is resistant to historical cash crises like hyperinflation caused by governments devaluing their currency on purpose or by accident. It brings the flexibility and anonymity of cash and barter to the digital realm, allowing individuals to transact without oversight or intermediaries. And in a one-paragraph pitch, you can see the appeal. There's a compelling narrative there. But, of course, in the 12 years since then, none of that played out as designed. Bitcoin was structurally too slow and expensive to handle regular commerce. The whole thing basically came out the gate as a speculative financial vehicle, and so the only consumer market that proved to be a viable use was buying and selling prohibited drugs, where the high fees, rapid price fluctuations, and multi-hour transaction times were mitigated by receiving LSD in the mail a week later. And as far as banking is concerned, Bitcoin was never designed to solve the actual problems created by the banking industry, only to be the new medium by which they operated. The principal offering wasn't revolution, but at best a changing of the guard. The gripe is not with the outcomes of 2008, but the fact that you had to be well connected in order to get in on the grift in 2006. And even the change of the guard is an illusion. Old money finance assholes like the Winklevoss twins were some of the first big names to jump onto crypto, where they remain to this day. Financial criminal Jordan Belfort, convicted of fraud for running pump and dump schemes and barred for life from trading regulated securities or acting as a broker, loves crypto. Venture capitalist Chris Dixon, who has made huge bank off the old web in his role as a general partner at VC firm Andreessen Horowitz, is super popular in the NFT space. He likes to paint himself as an outsider underdog.
What? Alec Jules is debating Vosh for Shoe on Head in voice chat right now. I just looked at this tweet. I know I'm right. God damn it. I'm so fucking right. Vosh is never going to go public with it because he knows that I called it. He knows I called it. And he's probably telling June. He's like making up all these videos like, oh, well, it'd be easier for our lives to be warm, blah, blah, blah. But I know they're fucking dating. I know it.
Dog fighting the gatekeepers, but he also sits on the boards of Coinbase, a large cryptocurrency exchange that makes money by being the gatekeeper, collecting a fee on all entries and exits to the crypto economy, and Oculus VR, which is owned by Meta, nay Facebook. Peter Thiel, who also went
Wait.
keepers, but he likes to paint himself as an outsider underdog fighting the gatekeepers, but he also sits on the boards of Coinbase, a large cryptocurrency exchange that makes money by being the gatekeeper, collecting a fee on all entries and exits to the crypto economy, and Oculus VR, which is owned by Meta, nay Facebook.
Okay, wait, is that really fair? Is that really a fair critique?
Love you, chat DGGL.
If I say something like, I want to challenge like the major financial, God, dude, I don't want to have to defend fucking crypto shitters. If I say something like, hey, I'm going to be the vanguard, I want to defend people's right to move around currency as they want, not have to worry about the government doing anything, blah, 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 blah. And it's like, oh, so you don't want the government and financial currency to be gatekept, but here you are charging fees in order to buy and sell crypto on a platform? Like, is that really a fair critique? Like, the guy, that seems silly to me, but okay.
Facebook. Peter Thiel, who also went from wealthy to ultra wealthy off the Web2 boom via PayPal, loves crypto and is friends with a bunch of eugenics advocates who promote cryptocurrency as a return to sound money for a whole bunch of extremely racist reasons, because when they start talking about banks and bankers, they mean Jews. Some of the largest institutional holders of cryptocurrency are the exact same investment banks that created the subprime loan crash. Rather than being a reprieve to the people harmed by the housing bubble, the people whose savings and retirements were unknown to them being gambled on smoke, cryptocurrency instantly became the new playground for smoke vendors. This is a really important point to stress. Cryptocurrency does nothing to address 99% of the problems with the banking industry, because those problems are patterns of human behavior. Their incentives, their social structures.
I wish that he would have opened. I probably agree with everything this guy is going to criticize crypto on, or at least most of it. But I wish he would have opened with the sound critiques and not like the blatant fucking shitting on it. Because it sounds like this guy really hates crypto. It sounds like he's really ass mad about it. Like now it makes me like, I'll listen to any opinion, but if I wasn't an open-minded person, I would have already shut this video off. He just sounds like a massive fucking hater. Like he's got a rage boner against crypto.
Their modalities. The problem is what people are doing to others, not that the building they're doing it in has the word bank on the outside. In addition to not fixing problems, Bitcoin also came with a pretty substantial drawback. The innovation of Bitcoin over previous attempts at digital currency was to employ a distributed append-only ledger, a kind of database where new entries can only be added to the end, and then to have several different nodes called validators compete over who gets to validate the next update. These are, respectively, the blockchain and proof-of-work verification. Now, proof of work has an interesting history as a technology, typically being deployed as a deterrent to misbehavior. For example, if you require that every email sent, the user's computer has to compute a small math program. It places a trivial load onto normal users sending a few dozen or even a couple hundred emails a day, but places a massive load on the infrastructure of anyone attempting to spam millions of emails. How it works in Bitcoin, simply put, is that when a block of transactions are ready to be recorded to the ledger, all of the mining nodes in the network compete with one another to solve a cryptographic math problem that's based on the data inside the block. Effectively, they're competing to figure out the equation that yields a specific result when the contents of the block are fed into it, with the complexity of the desired result getting deliberately more difficult based on the total processing power available to the network. Once the math problem has been solved, the rest of the validation network can easily double-check the work, since the contents of the block can be fed into the proposed solution, and it either spits out the valid answer or fails. If the equation works and the consensus of validator signs off on it, the block is added to the bottom of the ledger, and the miner who solved the problem first is rewarded with newly generated Bitcoin. The complexity of the answer that the computers are trying to solve scales up based on the network's processing power, specifically to incur heavy diminishing returns as a protection against an attack on the network where someone just builds a bigger computer and takes over. Critics pointed out that this created new problems. Adversarial validation would deliberately incur escalating processing costs, which would in turn generate perverse structural incentives that would quickly reward capital holders and lock out any individual that wasn't already obscenely wealthy, because while the escalating proof-of-work scheme incurs heavy diminishing returns are still returns. So more would always go to those with the resources to build the bigger rig. no matter what Bitcoin future was envisioned, in the here and now, computer hardware can be bought with dollars. Rather than dismantling corrupt power structures, this would just become a new tool for existing wealth.
We kind of ignore this, but it was the case. I don't know how old a lot of you guys are, but it was the case that way back in the day, people's delusions about crypto was that like it was going to be awesome because everybody could mine it in their homes. Like everybody was downloading miners. People were asking, what's the best GPU? Like for a while, I think people were buying, it was either AMD or NVIDIA. I don't remember which one, but it was like one. I think AMD cards were better at mining crypto than NVIDIA ones because like I think CUDA cores didn't work as well as like the stream processors or whatever on an AMD chip or something. It was something like that. And everybody was like, oh yeah, like we're buying the best cards and we're mining at home and this is so cool. And like, what's your electricity cost? Like if you live in the right state, it's better. Like that was like the obsession with that. And then that immediately, especially once these ASICs started coming out, basically specialized cards that let you solve just for Bitcoin problems, that went away almost immediately.
Exactly what happened. Thus began an arms race for bigger and bigger processing rigs, followed by escalating demands for the support systems, hardware engineers, HVAC, and operating space needed to put those rigs in. And don't worry, we're not forgetting the power requirements. These rigs draw an industrial amount of power, and because of the winner-takes-all nature of the competition, huge amounts of redundant work are being done and discarded. Estimates for this power consumption are hard to verify. The data is very complex, spread across hundreds of operators around the globe who move frequently in search of cheap electricity, and it's all pretty heavily politicized. But even conservative estimates from within the crypto mining industry puts the sum energy cost of Bitcoin processing on par with the power consumption of a small industrialized nation. Now, evangelists will counter that the global banking industry also uses a lot of power, gesturing at things like idle ATMs humming away all night long, which is, strictly speaking, not untrue. On a factual level, the entire global banking industry does, in fact, use a lot of total electricity. But for scale, it takes 6 hours of that sustained power draw for the Bitcoin network to process as many transactions as Visa handles in 1 minute. And during that time, Visa is using fractions of a cent of electricity per transaction. And that's just Visa. That's one major institution. So, yes, globally, the entirety of the banking industry consumes a lot of power, and a non-trivial portion of that is waste that could be better allocated. But it's also the global banking industry for 7 billion people, and not the hobby horse of a few 100,000 gambling addicts. So just to head all this off at the pass, Bitcoin and proof-of-work cryptocurrency aren't incentivizing a move to green energy sources like solar and wind, they are offsetting it. Because electrical consumption, electrical waste,
Wait. Wouldn't they be valuing it? I feel like they would be moving towards, I feel like there's got to be some incentive. There must be some Bitcoin farmers somewhere that are trying to like fucking build like solar farms or some shit. That has to be the case.
No.
No?
No.
It's not more, assuming there aren't weird tax incentives or whatever, wouldn't there be people that would be trying to set up in places where energy is cheaper, and wouldn't it tend to be cheaper in places that have a lot of solar power or whatever?
No, the cheapest place is going to be hydro. Solar is just too unreliable. Now, you do have people that are building mining operations kind of in Texas, where there's a lot of wind power, but they're really doing a lot of hedging. Solar is just too unreliable. Same thing with wind power, It's just, you can get cheap stuff, but in general, you have to keep in mind, look, right now with Ethereum and Bitcoin mining, let's say that you were to mine from your fucking house, you would be like, hey, it's not that great to mine from my house here, right? The power, but it's still profitable to do it. So you're going to have people doing it. You're going to just look for a 24-hour cheapest cost, right? Does that make sense? So if you can set up somewhere where you get
but I feel like right now, I feel like the cheapest price I thought was solar. Now it might be the case that people aren't shopping specifically for that because some states offer incentives or whatever for different energy plans, or they're subsidizing in some way. But I thought that the cheapest energy per kilowatt right now was solar, at least from an operational point of view. But I think that just changed recently, like over the last 2 years, I think. So
yeah, I mean, I will tell you the one thing that people do a lot. Any big facility, what they do is for mining facilities, like almost all of them now, because they're scared of legislation, they all buy carbon credits to make them all renewable. So like any big mining facility now, like every single one is going to be green. which means that they take away more CO2 than they cause, because it's cheap to buy the credits. And why wouldn't you do that? Because then you can tell everyone, hey, listen, I'm good for the environment. Does that make sense?
Yeah, I know what you mean.
Okay.
Okay.
Is the value that underpins Bitcoin. Miners spend X dollars in electricity to mine a Bitcoin. They expect to be able to sell that coin for at least X plus profit. When new power sources come online and the price of electricity goes down, they don't let X go down, they build a bigger machine.
Jesus.
In 2012, Vitalik Buterin, a crypto enthusiast and butthurt warlock main, set out to fix what he saw as the failings and inflexibilities of Bitcoin. Rather than becoming the new digital currency, a thing that people actually use to buy stuff, Bitcoin had become an unwieldy speculative financial instrument, too slow and expensive to use for anything other than stunt purchases of expensive cars. It was infested with money laundering and mired in bad press. After the FBI shut down Silk Road, you couldn't even buy drugs with it anymore. In practice, you couldn't do anything with your Bitcoin but bet on it. Lock up money you already have in the hopes that Bitcoin goes up later, and pray you don't lose it all in a scam, lose access to your wallet, or have it all stolen by an exchange. The result, launched in 2014, was Ethereum, a competing cryptocurrency that boasted lower fees, faster transaction times, a reduced electrical footprint, and most notably, a sophisticated processing functionality. While the Bitcoin blockchain only tracks the location and movement of Bitcoins, Ethereum would be broader. In addition to tracking Ether coins, the ledger would also be able to track arbitrary blocks of data. As long as they were compatible with the structure of the Ethereum network, these blocks of data could even be programs that would utilize the validation network as a distributed virtual machine. Vitalik envisioned this as a vast, infinite machine, duplicated and distributed across thousands or millions of computers, a system onto which the entire history of a new internet could be immutably written, immune to censorship and impossible for governments to take down. He saw it dismantling banks and other intermediary industries, allowing everyone to be their own bank, to be their own stockbroker, to bypass governments, regulators, and insurance agencies. His peers envisioned a future where Ethereum became not just a repository of financial transactions, but of identity, with deeds, driver's licenses, professional credentials, medical records, educational achievements, and employment history turned into tokens and stored immutable and eternal on the chain. Through crypto and the Ethereum virtual machine, they could bring all the benefits of Wall Street investors and Silicon Valley venture capitalists to the poorest people of the world, the unbanked and forgotten. This heady, high-minded philosophy is outlined in great detail in the journalistic abortion, The Infinite Machine, by failed journalist turned crypto shill Camilla Russo. The book is actually really interesting.
I might be exposing myself because I don't know. I don't know if this guy is intentionally styled his hair this way or if this is just like a type of male pattern baldness, but I feel like the type of male pattern baldness where you have like the little circle of hair in the middle, I feel like this looks kind of cool. I feel like it works. Do you think?
Not for the merits of the writing, Rousseau fails to interrogate the validity or rationality of even the simplest claims and falls just shy of hagiography by occasionally noting that something was a bit tacky or embarrassing, but only just shy. She tells florid stories about the impoverished people that Vitalik and friends claim to be working to save, but never once considers that the solutions offered might not actually work, or that the people claiming to want to solve those problems might not even be working on them. That's actually a big issue, since the entire crypto space, during the entire time that Rousseau's book covers, was absolutely awash with astroturfing schemes, where two guys would go to some small community in Laos or Angola, take a bunch of pictures of people at a crypto investing seminar, generate some headlines for their coin or fund, and then peace out. For years, dudes were going around asking vendors if they could slap a Bitcoin sticker onto the back of the cash register because the optics of making it look like a place takes Bitcoin was cheaper and easier than actually using Bitcoin as a currency. We have an entire decade of credulous articles about how Venezuela and Chile are on the verge of switching entirely to crypto, based entirely on the claim of two trust fund dudes from San Bernardino. A whole 10 years littered with discarded press releases about Dell and Microsoft and Square bringing crypto to the consumers before just quietly discontinuing their services after a year or two when they realized the demand isn't actually there. The fact the development of Ethereum was extremely dependent on a $100,000 fellowship grant from Peter Thiel is mentioned, but the ideological implications of that connection are never explored. The entire subject occupies a single paragraph, sprinkled as flavor into a story about Vitalik and his co-developers airing their grievances about some petty infighting. The book is mostly useful for its value as a point of reference against reality. It's a very thorough, if uncritical, document of absolutely insane claims. The idea was that the traits of blockchain technology, such as having no central point of failure, being uncensorable, cutting out intermediaries, and being immutable, could also benefit other applications besides money. Financial instruments like stocks and bonds and commodities like gold were the obvious targets, but people were also talking about putting other representations of value like property deeds and medical records on the blockchain too. Those efforts, admirable considering Bitcoin hadn't and still hasn't been adopted widely as currency, were known as Bitcoin 2.0. I love this paragraph because it outlines just how disconnected from reality the people actually building cryptocurrencies really are. They don't understand anything about the ecosystems they're trying to disrupt. They only know that these are things that can be conceptualized as valuable and assume that because they understand one very complicated thing, programming with cryptography, that all
Why is your night vision so fucking bright? I don't know. It just is in my game. I don't know why.
other complicated
Can you make it not as
things
bright?
must be lesser in complexity and naturally lower in the hierarchy of reality. Nails easily driven by the hammer that they have created. The idea of putting medical records on a public, decentralized, trustless blockchain is absolutely nightmarish, and anyone who proposes it should be instantly discredited. The fact that Rousseau fails to question any of this is journalistic malpractice. Now, in terms of improvements over Bitcoin, Ethereum has many. It's not hard. Bitcoin sucks. In terms of problems with Bitcoin, Ethereum solves none of them and introduces a whole new suite of problems driven by the techno-fetishistic egotism of assuming that programmers are uniquely suited to solve society's problems. Vitalik wants his invention to be an infinite machine, so let's ask what that machine is built to do.
Yes, I love the smashing percussion drums. God, this is so hip and awesome.
In order to really understand the full scope of this, we do need to dig a bit more into the technical aspects because that technical functionality informs the way that the rest of the system behaves. In a very McLuhanist way, the machine shapes the environment around it. As already mentioned, a blockchain consists of two broad fundamental components, the ledger and the consensus mechanism. All currently popular blockchains use an append-only ledger. Now this is, on its own, not that remarkable. Append-only is just a database setting that only allows new entries to be added to the end of the current database. Once something is written to the database, it's read-only. Standard applications are typically things like activity logs, which is conceptually all a blockchain really is, a giant log of transactions. The hitch is that it's decentralized, with elective participants hosting a complete copy of the entire log, and this is where the second component comes in, the consensus mechanism. All validating participants, called nodes, have a complete copy of the database, and no one copy is considered to be the authoritative copy. Instead, there is a consensus mechanism that determines which transactions actually happened. This is all the proof of work stuff. Proof of work isn't the only consensus mechanism, but it's popular because it's very easy to implement by just cloning Bitcoin and is resilient against the kind of attacks that crypto enthusiasts care about. It's a very brute force solution, but legitimately, if you want a network of ledgers where no one trusts anyone else, just making everyone on the network do extreme amounts of wasted duplicate work is a solution. One of the major problems that this machine solves is what's called the double spend problem. How do you stop someone from spending the same dollar twice? If someone tries, how do you determine which transaction really happened? Banks solve this problem by not correlating account balance with any specific dollar, processing transactions first come first serve, which they track with central resources, and punishing users with overdraft fees for double spending. Eschewing a central solution, cryptocurrencies rely on their consensus mechanism. The most popular alternative to proof of work is proof of stake, where validators post collateral of some kind, usually whatever currency is endemic to the chain, with the amount of collateral determining their odds of being rewarded the validation bounty for any given transaction. The main proposal of proof of stake is that it significantly reduces the wasted power problems of proof of work, but it's less resilient than proof of work. On the energy cost side of things, proof of stake is still inefficient just by virtue of the sheer volume of redundancy, but on a per user basis, it's at least inefficient on the scale of like an MMO as opposed to a steel foundry. This is difficult to assess because the most popular proof of stake chains are still unpopular and low traffic in the scope of things, heavily centralized. Claims about scalability are backed up by nothing but the creator's word. Proof of stake is also significantly more complex because there now needs to be some mechanism for determining who gets to do the validations and also determining how audits are conducted, and then the question of who has control over that system and whether or not someone can gain control of that system or control over the whole stake via just buying out the staking pool, etc., etc., etc. Proof of stake also even more explicitly rewards the wealthy who have the capital to both stake and spend. It's also even more explicitly exclusionary. Ethereum's proposed proof of stake migration has a buy-in of 32 Ether, which at the time of writing is about $130,000. So really only early adopters and the wealthy can actually meaningfully participate for more than just crumbs. This is, in turn, compounding inherent problems with the long-term growth of the chain. Even if you solve the escalating power requirements of proof of work, the data requirements of storing the chain and participating as a validator are also prohibitive in a way that inevitably centralizes power in the hands of a few wealthy operators.
85 terabytes per year is totally fine, right? Like, because 85 terabytes per year, like if you have even one person that just keeps buying like a $100 hard drive, like I think once every month, then they can store it, right? Like it's something like that. So it's too big for just like a casual user that just wants to run the chain on their laptop, but one dedicated user who cares, like they can totally afford to store the chain. So 85 terabytes, not a big deal, right? But once you crank that number higher, there comes a point at which it starts becoming a really big deal.
Hold on, it's been so long since I've looked at the size cards. 85 terabytes. You can store that on one $100 drive? Or is he saying you add a new $100 drive a year? What are hard disk drives even at these days? Is it like 4 to 8? Oh, it's every month. Okay. Interesting. That's a lot of work for a dedicated user, right? Because you'd have to... Would you care about having like redundancy and everything set up? Maybe, I don't know. Maybe it's... Who cares? Why do you need redundancy? Everyone else has a copy, right?
The major downside of all these systems is that they're extremely slow. Proof of work is inefficient by design, and proof of stake has multiple layers of lottery that need to be executed before any transaction can be conducted, and, in particular, suffers from delays when elected validators are offline and the system needs to draw again. As an extension of being slow, they're also prone to getting overwhelmed if too many people try to make transactions simultaneously, which can cause desyncs between validators and even lead to what's called a fork, where two or more pools of validators reach a different consensus about the state of the network, and each branch keeps on going afterwards, assuming that it is the authoritative version. Forks can also be caused on purpose, and this is, in fact, the only way to effectively undo transactions. Like, if someone stole your coins, the only way to get them back would be to convince the people who manage the chain itself to negotiate a rollback. That's foreshadowing for later. Now, because the nature of a fork involves a disagreement on what transactions actually happened and who got paid for those transactions, this means that each arm of the fork has a vested interest in its own arm being the authoritative arm. So resolving forks can turn into irreconcilable schisms, which is funny as an outside observer viewing it as an inane internet drama, but is frankly unacceptable for anything posturing as a serious and legitimate currency. Like, it's important to stress that because of the nature of the chain, the way that the ID numbers of later blocks are dependent on the outcomes of previous blocks, these aren't just a few disputed transactions that need to be resolved between the buyer, the seller, and the payment processor. These are disagreements on the fundamental state of the entire economy that create an entire alternate reality. It's an ecosystem that absolutely demolishes consumer protection.
Here's something that I'm curious about. Is Dan here or is he AFK? Fuck. Let's say that you had a bank account.
What?
Let's say that in Wells Fargo, I have a bank account, okay?
Yep.
Let's say that somebody goes to the back end and they added like 10 no, we'll say they add like 3 zeros to my account balance, okay? They give me like $1 million or some shit. I'm assuming that there's not like, Wells Fargo isn't like moving a physical dollar in and out of a bank account every time like I do a transaction. How would they find that error?
So I think all banks have. This is my assumption because I have no fucking idea. But my assumption is that they have a balance that's probably synced up to Treasury every once in a while, saying these are the assets I have, and it has to be that amount. And if that,
Yeah, but the thing is that at the end of the day, I imagine all of this is probably digital, right? Like, is
Yeah,
there
for
any
sure.
type of physical money counting happening anymore, or?
For stuff on hand, yeah, I think cash assets are definitely treated differently because the government wants to keep track of that because it's used, predominantly for bad stuff. That's the same reason you have to do that report if you send over 10 grand or anything like that. You know what I mean? So
Yeah, true.
I definitely think physical cash is treated very differently and under a different standard than like, if I send you a wire of $50,000, there's two things that happen. One, I don't have to do that report. You know that, right? The whatever the fuck it's called, the I forget the name of it. The thing that's over $10,000. You don't do that report, and you don't receive it either. But if I was going to take out $10,000 and give it to you 5 times, it would be like a fucking shit show. So there's that. But
Okay.
yeah, I don't have an actual answer. Sorry.
I'm gonna use the restroom real quick. 1 sec.
Because I'm putting 100%.
I'm back. What'd I miss? Nothing. Okay. Good luck.
And makes the re-implementation of them extremely difficult. One of the big selling points of all this technology is that it's particularly secure, very difficult for anyone to hack it directly since there's so much redundancy. A lot of hay is made about the system's resiliency against man-in-the-middle attacks, which are your classic Hollywood hacker type attacks. Someone sends a command from point A, and on the way to point B, it is intercepted and altered. Someone hacks into the bank and adds an arbitrary number of zeros onto their account balance. Evangelists will commonly claim that blockchain could revolutionize the global shipping industry and reduce fraud. It's a good claim to interrogate. First, the things that blockchain is capable of tracking are things that manufacturers and shippers are already tracking, or at least trying to track. So this is not so much revolution as it would be standardization. Even that is built on a predicate assumption that everyone picks the same chain. It's an extremely optimistic assumption. Many firms deliberately want their information centralized and obfuscated to protect against corporate espionage. The lack of a shared, standardized bucket to put all the information into is not because it's been heretofore impossible, but because it's been undesirable. Second, it assumes the existence of a theoretical mechanism that ensures the synchronization of the chain and reality above and beyond the current capacity of logistics software. Some means of preventing people from just lying to the blockchain and giving it the information it expects to be receiving, the blockchain equivalent of ripping off the shipping label and slapping it on the new box. The bigger problem here is that in the pantheon of fraud, man-in-the-middle attacks are actually pretty rare. Global shipping needs to deal with it in certain capacities, but taken on the whole, the vast majority of fraud doesn't come from altering information as it passes between parties, rather from colluding parties entering bad information at the start. Con artists don't hack the Gibson to transfer your funds to their offshore account, they convince you to give them your password. Most fraud comes from people who technically have permission to be doing what they're doing. Rather than preventing these actual common types of fraud, cryptocurrency has made them absurdly easy, and the main reason why cryptocurrency needs to be so resistant to man-in-the-middle attacks is because the decentralized nature of the network otherwise makes them acutely vulnerable to those attacks. What this all kind of means is that blockchains are all pretty bad at doing most of the things they're trying to do, and a lot of the innovations in blockchains are attempts at solving problems that blockchains introduced. The biggest issue that cryptocurrencies have suffered from is a lack of tangible things to actually use them on as currencies, rent or food or transit. This is for pretty simple reasons. One is that the transaction fees on popular chains are so prohibitive that it's pointless to use them on any transaction that isn't hundreds, if not thousands of dollars. No one is going to buy the Bitcoin bucket from their local KFC. Ethereum's main transaction fee, called gas, on a good day runs around $20 US per transaction. But that's severely optimistic. As of December 2021, the daily average cost of gas hasn't gone below $50 US since August, with the 3-month daily average riding over $130. And that's just the daily average. The hourly price can, and does, swing by up to 2 orders of magnitude. The throughput of blockchains is so abysmal that transaction slots are auctioned off to the highest bidder. That's why these numbers are so extreme. It only takes a few high rollers competing on a transaction to drive the hourly price of gas up over $1,000 US. The internal term for this is a gas war, because it's just that common. Bots, in particular, can drive gas prices well into the tens of thousands of dollars as they compete to capitalize on mistakes, such as someone listing something for sale well below its general market price. Also, it needs to be stressed, these gas wars aren't localized to just the thing that's being fought over. If Steam is getting hammered because Concerned Ape posted Stardew Valley 2 by surprise, that will probably stay pretty well contained. If Taylor Swift concert tickets go on sale and Live Nation gets crushed, you might never even know. What those don't do is cause the cost of placing an order on DriveThruRPG to spike by 8,000% for 3 hours. The second big...
I heard that there were huge issues. This is one of the reasons why people were saying Bitcoin was eventually going to be abandoned, was because transaction costs were getting really high. But then I heard that there was like plans to solve this somehow, either through a big fork or something. Did this ever get solved, or...?
Reason is that value on the coins themselves is so volatile that unless you're willing to engage with the speculative nature of the coins, there's actually a huge risk in accepting them as payment for anything. Bitcoin in particular, owing to its glacial transaction times, suffers from problems where the value of the coin can change dramatically between the start and end of a transaction. This is such a problem that it's led to the rise of an entire strata of middlemen in the ecosystem, so-called stablecoin exchanges like Tether that exist to quickly transfer cryptocurrencies between each other and lock in values. The stablecoins, rather than having a speculative value, have a value that's pegged to the value of an actual currency, like the euro or US dollar. The underlying problem that they exist to solve is itself twofold. One is that converting cryptocurrency into dollars is the step of the process that makes you accountable to the taxman, and the primary goal of crypto in general is to starve public services, so that's a no-go. The second is that there just aren't actually that many buyers, and there's not enough liquidity in the ecosystem to cash out.
Oh shit, hold on, I'm so sorry. This is so boring. We're working our way through. Apparently that commie girl that we responded to on TikTok saw my response on TikTok and responded to my response on TikTok. Oh boy. Like complete with the cringe, awkward laughs and everything. Holy shit. Okay.
Big holdings. Tether, the largest stablecoin, used to advertise itself as being backed on a one-to-one basis back when it was called Realcoin, but that language has become far more nebulous over time as it's become obvious that it just isn't true. This is a very complicated situation, but the short version is that the people who own Tether also own a real money exchange called Bitfinex, and there's evidence that the two services, both which require having actual dollars on hand in order to back their products and facilitate exchanges, are sharing the same pool of money, swapping it back and forth as needed. This means that at any given time, either service is potentially backed by $0, or at least that's what the data implies might be the case. Point is that if you're a high roller with hundreds of millions of conceptual dollars tied up in cryptocurrency, there's a fundamental cash problem. Your holdings have inflated to tens, hundreds, or thousands of times what you put in, but that price is just theoretical.
Just call her princess and move on.
You have all this crypto, you can't meaningfully spend it, and there's not enough buyers for you to get it out. In order for you to cash out, you need to convince someone else to buy in. These factors, taken holistically, mean that cryptocurrency is a bigger fool's scam. There's a lot of digital ink spilt trying...
Wait, what?
...to outlet crypto to get it. All this problem. Millions of implies might be the case. Point is that if you're a high roller with hundreds of millions of conceptual dollars tied up in cryptocurrency, there's a fundamental cash problem. Your holdings have inflated to tens, hundreds, or thousands of times what you put in, but that price is just theoretical. It's speculative. You have all this crypto, you can't meaningfully spend it, and there's not enough buyers for you to get it out. In order for you to cash out, you need to... How much, if you're talking about any large cryptocurrency, how much are you holding that you're going to move the market on your own, just exchanging your currency for USD? Like, what? Convince someone else to buy in. These factors, taken holistically, mean that cryptocurrency is a bigger fool's scam. There's a lot of digital ink spilt trying to
Isn't he describing literally every single commodity of finite scarcity or whatever in existence? Like, couldn't I take that same argument and apply it to gold or silver? Like, let's say that you own $100 million of gold. Well, now you have a huge problem. In order for you to trade that gold of theoretical value into real value, like USD, you're going to have to find somebody else to buy into that gold. Like, this is every single commodity ever, or every single store of wealth, or every single, yeah, or the entire stock market. Like this is kind of a weird point, but okay.
outline if it's a decentralized Ponzi scheme or a pyramid scheme or some hybrid of the two, which is a taxonomical argument that I'm not here to settle, but like both of those, it's a bigger fool scam. The whole thing operates by buying worthless assets, believing that you will later be able to sell them to a bigger fool. The entire structure of
this is like describing the entire stock market. I'm not buying shares of Walmart because I hope that one day I'm going to own so many shares I can sit on the board. I'm buying shares of Walmart in the hopes that one day I can sell it to somebody else who wants to own shares of Walmart for more than what I bought it for.
Of cryptocurrencies at their basic level of operation is
yes for gold and silver, no for stocks. Stocks generate dividends and represent future cash flows. There is value outside of resale. First of all, not all stocks pay dividends. I'm pretty sure the hot popular thing to do right now is to not pay dividends, right? For a lot of tech stocks. So not all stocks necessarily pay dividends. And they represent future cash flows. So they kind of do in a way, but not necessarily. A stock doesn't necessarily represent anything. A stock is only bought and sold for what somebody else is willing to buy and sell it for, right? Like you can't really say that, you can't really sit here and tell me with a straight face like, oh, Tesla has a valuation of like $55 trillion because that's representing future cash flows. No, it is a valuation because people think that in the future they're going to be able to sell those stocks for more than what they're paying now, plus whatever interest they want to be paid for holding the stock for X amount of time.
designed to deliver the greatest rewards to the earliest adopters, regardless of if you're talking about proof of work or proof of stake. This is inherent to their being. As Stephen Deal put it, these schemes around crypto tokens cannot create or destroy actual dollars. They can only shift them around. If you sell your crypto and make a profit in dollars, it's only because someone else bought it at a higher price than you did. And then they expect to do the same, and so on and so on.
This is every single scarce product ever. I feel like this is just a dog shit. It's true. What he's saying is true. It's just not necessarily bad. Like, this is just... like, all of gold and silver and anything like that is, like, represented by the same argument. Destiny. The price a person is willing to pay is fundamentally based on what they think the future cash flow will be. 31 Drinky 31. That is not true. It's like an infinitely recursive argument. What somebody is willing to pay is what they think somebody else might be willing to buy it for, which is what they think they will buy and sell it for, which is like infinitely down to like what future cash flows will be, right? There's like a ton of different information that's incorporated into the underlying price of a stock. There's so much information. The idea that it's literally just as simple as like, oh, well, it's just the fundamental value of the company. We just look at cash flows less, assets and liabilities. Like that is it would be cool if that's how stock prices were decided, but that's absolutely not the case, right? This might be like a baseline to start, but fundamentally.
Ad infinitum. Every dollar that comes out of cryptocurrency needs to come from a later investor putting a dollar in. Crypto investments cannot be anything but a zero-sum game, and many are actually massively negative sum. In order to presume a crypto investment function...
But there's a difference between value and price. That's why I said price. That's why I said the price of a stock. It has so much information that plays into it. Yeah, get out of here, Dan. But there's a fundamental value underneath traditional stocks. Tesla is wildly diverging from a company. Sure, but like look at GME. That's another example. GME, the value of that stock, the true value, whatever you want to say value is significantly less, like 10% of what the price has been of that stock for what, almost a year it's been trading for, like that, But
functions as a store of value, we must simultaneously need to suppose an infinite chain of greater fools who keep buying these assets at any irrational price and into the future forever.
It's also not irrational. That's not an irrational thing. If you buy Bitcoin expecting to sell it in the future because someone else will pay more for it than you did, that's not necessarily irrational.
All right, with all that out of the way, let's talk about the ape in the room.
NFTs, non-fungible tokens. On a conceptual level, the tech acts as a sort of generic database to mediate the exchange of digital stuff. The most optimistic read on it is a framework for a type of computer code that creates so-called true digital objects.
All institutional investors make the calculation of future cash flows in order to decide whether to buy or sell. It's only private investors. Fuck! Somebody linked me a super interesting article by, I don't know if this guy's a memer or not, but Matt Levine, he writes about financial stuff. I don't know if Rage Pope or Irk linked it in chat, but it was a really, really interesting article about how pharmaceutical companies might be incentivized to lose money. Because the structure of institutional investment portfolios is such that if you have a folder, if you've got a portfolio of like 1,000 different companies, and one of those companies, a pharmaceutical, can lose a lot of money getting a vaccine out that will boost the earnings or boost the value of all of your other holdings, that institutional investors might be incentivized while holding pharma stock to encourage that pharma stock to like take losses in that business such that it hoists up the rest of their portfolio. It was a really interesting read. Oh, this one. Oh, oh yeah, it was a Bloomberg article. I'm not going to read this on stream, but money stuff, you don't need props anymore. The way that he explains it is like very, very, very interesting. I never considered, yeah. But anyway, regardless, sorry. Okay. Link in chat, please. Vatioli just linked it.
Did that call?
Wait, I'm not looking at you. Oh God, we're 40 minutes out of 2 hours and 20 minutes.
Meaning digital objects that possess the attributes of both physical objects and digital, being losslessly transmittable while providing strict uniqueness, which is an important concept. Strict uniqueness is a way of saying that two different things are different things, even if they're different copies of the same thing. My copy of Gray by E.L. James is strictly unique. While millions of copies of the book exist, this is the only copy that is this copy, and this is the only copy that has the very specific damage of being glued shut and thrown into the Bow River. It is also strictly scarce. While millions of copies of Gray exist, that's still a finite number, meaning it is possible, though not immediately practical, for the world to run out of copies. NFTs impose a simulacrum of this physical scarcity and uniqueness onto digital objects within their ecosystem. On a technical level, non-fungible token is just a token that has a unique serial number and can't be subdivided into smaller parts. Two tokens, even two that tokenize the same conceptual thing, are still strictly unique with different serial numbers. Within the context of Ethereum and its clones, these tokens are effectively a small packet of data that can contain a payload of code. It's a box that you can put a microprogram into. That microprogram is called a smart contract, a name that is so comically full of itself that I feel like it's misleading to even call them that, but I have to for simplicity's sake. But real quick, yes, that is how the inventors conceptualized the role of these things, as the unity of programming and law. The phrase code is law gets bandied about as an aphorism, and it's just so full of holes that we're going to be spending the next forever talking about it. Before we move into that, this is the root of it. There is a tremendous disconnect between what NFT advocates say they do and what they actually do. But, and this is very important, both the claimed functionality and the actual functionality are both bad. It's all broken, none of it works well, so the idea of it becoming the norm is terrible. But the prospect of what the world would look like if all the mythologizing and overpromising came true also super sucks. The end goal of this infinite machine is the financialization of everything. Any benefits of digital uniqueness end up being a quirk, a necessary precondition of turning everything into a stock market. There's nothing particularly offensive.
I'm glad you are doing a review of this video. I watched it yesterday, And it gives a lot to think about.
A lot.
Underpinning the concept of digital collectibles, frameworks and subcultures for forms of digital collectibles have existed for decades within various contexts, but NFTs exist to lend credibility and functionality to the cryptocurrencies that they exist on top of. Okay. Code is law. Now, what that little smart contract program does is up to the token creator. It can be a relatively sophisticated applet that allows the user to execute various commands, or it can be a plain hypertext link to a static URL of an image, or anything in between. Most are a lot closer to static URLs than they are to functional programs. This is in part because the thing that NFTs have become synonymous with are digital artworks, but really what the token represents is arbitrary. It can be a video game item, a permission slip, a subscription, a domain name, a virus that steals all your digital stuff, or a combination of all of those. Well, the concept has been floating around since 2015 when the framework was thrown together in a day during a hackathon and the first Ethereum implemented tokens were minted in 2017. For the mainstream, the story starts in the spring of 2021 following a string of high-priced sales of tokens minted by digital artist Beeple, culminating in a $69 million sale of a collage of Beeple's work in March via old money auction house Christie's. This high-profile...
Do you think these sales, all of these are legitimate? Like suckers looking for bigger suckers? Or do you think that there's like some fraud going on here? Like, here's a question, okay? Where is Dan? He's not here. Let's say that me, Dan Mooten, and a couple other guys got together and I wanted to start selling artwork. Let's say that I create 10 art pieces and I mint them as NFTs. And let's say that I get my friends to buy like 8 of these for $14,000, $15,000 each. And now I've got that transaction history of like, this guy makes NFTs, he sells them for this much money, they blah, blah, blah. Like, could I not have like NFT 9 and 10 and then just put that on the open market and get some random sucker to bid it up to like 15, 20,000 since he's seen them like,
Hello.
you know? Hello?
The answer to your question is yes, you could do that, but you're missing
This video sucks.
the big
Do more
kitty
Jim
cat
talk.
fraud in the room. You want to take a second and see if you can think about it?
Yeah, what is it? Or I don't want to take a second now. What is the big kitty cat fraud?
The big kitty cat fraud is, man, I got all this fucking crypto and I got to show how I got it because I got it from kind of a lot of places aren't too. How can I do that? Oh my God, I'm a genius. I'll create a new NFT that I have and I'll sell it for $1 million. And then my other crypto account can buy that NFT. And now that NFT is worth $1 million. I get to say I've made $1 million. Here's how I made it. Great. No, report that to the IRS. All good. Here's how I got it. And oh man, my other account now has an asset worth $1 million, but not really. So it might be able to sell that for 500K. You get it?
No.
You buy an NFT from yourself. What happens when you do that if you mint the NFT?
I don't know. I don't understand.
Well, okay, listen, this is not.
Wait, well, explain it to me. Why wouldn't I
Hey,
just
hold on.
why wouldn't I just
I got-
withdraw that $1 million from a crypto exchange? Why would I need to buy an NFT for myself first?
Okay, listen. I'm gonna have you forget about one part, and I'm just gonna do it one more time to even simplify it anymore. I want you to imagine, because you can have multiple crypto accounts. You understand this, right? And I say accounts, I mean like
Wallets, yes.
actual wallets. Okay.
Mhm.
Let's say that you go create your own NFT right now. Okay.
Mhm.
It's your mowing down protesters clip. You're gonna create it, and then you want this clip to be worth a lot of money. So what are you gonna do? You're gonna buy that clip yourself.
Oh yeah, sure. I understand that
$1
part.
million, okay? And now your main account, that $1 million that you spent with that may have been money that you've made selling drugs on the Silk Road, okay? And now you have a very legitimate way to say how you got that $1 million in tokens. You
Wait,
couldn't
why
really-
does the federal government care how you came across like your crypto? Does it ask you that? What is the source of your crypto? I thought you would just sell that
No.
on an exchange and then it would be like, oh, this is like a commodity that I traded and boom.
You want plausible deniability? And absolutely yes, 100%. Okay, you do not want to have any okay, so where did you get your $1 million? Oh, well, I sold it on Coinbase. Okay, we need to see that. And then, you're not worried about the IRS in this case. You're worried about the FBI. You want plausible deniability, saying, hey, listen, I sold an NFT for $1 million. I don't know anything about the buyer. Do you understand?
No. But I guess
Come
maybe.
on, you.
I understand what you're saying.
That.
I don't think the record transaction is that, but maybe it is. So like Rage Pub is saying, does the government care if I got $5 million for killing people for the cartels? I don't think so. If somebody's writing you a 1099, the government sees it. But maybe if they audit you or something,
not
maybe
the IRS. The people who are in charge of finding people who do murder for hire and sell drugs.
Oh yeah, okay, yeah. There might be some like esoteric branch of the government that researches like financial crimes like that. And then for them, yeah, it would be nice, I guess, to say that you got this. But this is such a ridiculously like naive or childish way of doing fraud. It feels like it would be caught immediately. Like, how did you make your money? Like the agent shows up at your house and Dan is like, oh, well, let me tell you, I have a picture of a monkey and I sold that for $5 million. I feel like I'd be like, really? 5 million? Find me the buyer. I want to talk to that person. And you'd be like, oh shit, I'm fuck. And you're like the FBI breaking your house.
Not.
And you gotta...
No, first off, you're not, because that's the way it works. And they have to prove, like, this is not, they have to prove it beyond a reasonable doubt. They can't just be like, this seems fishy.
Wait, no, stop, hold on.
Okay.
I don't know if you're making shit up or not. I don't think when it comes to financial crimes like that, I don't think
it's
they have to prove
it. It's not a financial crime, dude.
To have money illegally?
Forget about the IRS. Forget about taxes. This is you who have made all of your money in crypto from nefarious means, from selling drugs on the Silk Road or fucking whatever.
Yes, okay, yeah.
Stealing a huge amount of crypto is from stolen crypto.
Sure.
And stolen shit like that.
Yeah, Mt. Gox, I remember. Still waiting for my money. Yeah.
Okay, so people care about finding the people who stole that or did those crimes.
Okay, when you say people, you're talking about like non-government entities.
No, I'm talking about government entities. The FBI or fucking NSA, or not the NSA, but you don't understand. People care about you selling drugs on the internet.
Okay, but like, isn't this loophole like
being
so?
Naive?
No, it just sounds so silly. Like you're watching like Law and Order SVU, and they're like, well, where's the rape victim? It's like, well, I bought an NFT. You're never gonna find them.
I must be doing a bad job to explain this. A tremendous amount of crypto's uses is two things: stealing profits from people, hacking into people's wallets and taking their money, and selling fucking drugs. It's one of the only two useful reasons for Bitcoin in crypto in general.
Sure.
Okay.
Yeah.
Okay. Now, I want you to imagine that that's what you do personally. Let's say that you have
I basically scam people. That's what I do all day on stream. Yeah.
Let's
People get banned after subbing, and yeah.
Okay, so let's say that you have $500,000 in crypto.
Yeah.
Pay attention. Stop fucking around.
I'm listening. 500,000 in crypto. Okay.
And you can't just send that $500,000 to your Coinbase account.
Okay.
That's fucking.
You have to send it to a buying an ape account, and then you send it to your crypto account, and now you've completely obfuscated your money, your cash flow.
Yes. Yes, you have.
Okay.
Giga Chad, yes. How do you not fucking see
it just seems so simplistic.
Yeah, you don't get it. But I'm telling you to forget about all of that shit altogether. Can I give you a secondary thing? So that, by the way, that's a big thing right there. Okay.
Okay.
But that's not the biggest thing. The biggest thing is how do you double up in real life?
Kill your wife. Now you have 2x the assets, only one times or half the owner.
If you create an NFT, you personally create an NFT, okay? Or you have a friend who is an artist and create 10 NFTs, and you buy 7 of them for real money on the Ethereum chain. You spend a lot of money, okay? Like you said, there's someone else who can sell those 3. But here's the thing that you're forgetting, is that those 7 that you bought actually have value now by virtue of you purchasing them.
But if somebody was researching, they're going to know, where did you get the money to buy them?
What do you mean? Sorry, I'm not.
Let's say that the IRS, everybody goes to. Let's say everybody.
The IRS does not care about any of this. IRS cares.
Okay, no, but let's say somebody looks at you. You're like a random broke person. You're just a random working broke dude.
Yeah, sure.
And all of a sudden, you have an NFT worth $500,000, and then you sell it.
Create it.
You create the NFT, then you buy it yourself with $500,000 of your own crypto, and then you sell it. It's like, look, I got $500,000 legitimately. People are like, how'd you get that money? It's like, oh, well, I sold this. It was worth $500,000. I sold it. Well, how did you get it in the first place?
What, you created it?
So you created it, and out of nowhere, it's just worth $500,000?
Yeah, the crypto market is irrational. They have to prove without a doubt that what you're
Wait, why do you keep saying prove without a doubt?
Or beyond a reasonable doubt.
That's not true.
Of course it's true.
I'm almost positive that's not the case.
That is literally the fucking standard of guilt in the United States.
No, but I don't think there's different types of law. That's not like, if I have like $10 million in my bank account and the government asks me how I got that money in there, I can't just say like, well, if you can't prove I got it from an illegitimate source, you're fucked. I'm pretty sure you still get fucked there.
No, there's only one agency where that's not the case. Do you know what that is? Where you have to be on the offensive?
Where?
It's the SEC when you're dealing with stocks.
Okay, so right now, if I go murder somebody and there's no evidence, and I get paid $1 million to do it, I put $1 million in my account, and the government asks me, Where did that money
hold
come
on,
from?
hold on.
And I go,
Take me
fuck
through the
you,
steps.
find
Take
it.
me through the- take me
Yeah,
through the steps.
okay.
Okay.
Some guy gives me $1 million in cash, and he's like, I
In
need
cash?
you. Yeah.
What does cash have to do about it?
You just told me to walk you through it step by step. and I
Okay,
give you
so if someone
step-
pays you $1 million in cash,
Someone pays me $1
US
million in
fucking
cash,
dollars.
yeah, USD,
Yep.
to go kill somebody. And then I go kill somebody, and then I go deposit that money in my bank account. And then the IRS comes to me, and they're like, or the government, whoever gets tipped off from $10,000 plus transactions, and they're like, hey, where did that money come from? I don't think you can just respond, well, I'm going to say this. If you can't find where it came from as being an illegitimate source, then go fuck yourself. You can't do anything, right? Like, you'll pay tax on it and you're done.
Yes, you can. You're wrong.
Okay.
The IRS cares that you report income. Okay, that is what it cares. In fact, there's even memes about people not reporting income. Even in you look on your fucking tax return form, there is a section in there saying that you fucking sold drugs.
Yeah, there is a section. There is a line item on your... Yeah, that's true.
Okay, so that is not... The IRS cares about one thing. You paying taxes when you've made money. But that's not who we're worried about here. What we're worried about here is hiding that you got paid this money for what you really... How you really got it. You understand?
Okay. What if they see that you did the NFT shit and that becomes so synonymous with fraud that they just investigate you anyway?
Well, being investigated is something that you can't legislate or think about away. I could sue you tomorrow.
Well, if being investigated is something that matters, then why the fuck do you even go through all this work anyway? Isn't it just to ward off an investigation?
It's not about being investigated or being sued. It's about, will you prevail if anything happens, okay? Like, let's say that you had $1 million in crypto in your account and I hacked into your account and I stole it all. Me personally, and I have it. Now, I would be stupid if I took all that coins and I just sent it to my Coinbase account and took it out in cash. Why? Because very easily you can subpoena Coinbase and say, hey, that transaction, those are my coins. Who is this user?
Why not
And
just
then
send it through like a
hold
fucking
on,
Tumblr
let me
first or
finish.
something? Okay, go.
Hold on. Okay. So you want to have this this beyond a reasonable doubt. You want
But
to make it
like,
as
this is what I'm
difficult
proud
as
of.
possible.
All the ledgers.
You do a Tumblr, by the way. You do Tumblrs in lieu of this as well. But you're trying to not only just have your coins.
Sure, but I'm
crumbled,
just saying
you're
it's
also
like
trying-
somebody like looks at the wallet and they're like, oh shit, it didn't go straight to person A. First, it went to buy a newly minted NFT that was owned by person A. Huh?
No,
What
it
happened
wasn't owned
here?
by person A. You don't know who it was owned by. There's no way for them to prove, okay, that this was the case. They can speculate.
Oh
but they
wait,
have to
so this is
prove-
all anonymous. You don't know who owns it?
No.
Wait, in that case, why not just make another random anonymous like crypto wallet that nobody knows about?
Because then it doesn't show that there was any asset change. It's just you gave money to someone else.
How is that not an asset change?
This is something, when you just send money to another crypto account, you didn't receive anything at all? You didn't think that would view as a gift for you?
No, how do you know if somebody got something or not? Like if you're buying drugs on the Silk Road, you don't know if anybody got anything for the crypto.
So if it came down to that then you're getting you're doing a criminal case. They're going to say, so Mr. Saltman, why did you receive $1 million? I can't say I was buying a fucking NFT or anything on those lines or selling an NFT. I have to say, oh, I sold something, but I can't tell you what it was if it got to that point. This is a reasonable thing that you could say, hey, I sold this for money, okay, and that's what I did. It shouldn't be like, I don't know why it's this crazy.
I understand now. Okay, I understand.
You don't understand. You're saying you understand. But forget that whole thing.
I'm just imagining the conversation where the guy was like, well, no, I didn't steal the money from that guy that's missing $1 million, and I coincidentally have $1 million. I actually sold a picture of a monkey to some stranger online, and now the money's in my account, and you can't do anything about
Okay,
it.
so this is a very simplistic way that we're doing it.
Yeah.
Okay? Very simplistic way that we're doing it, and I'm trying to make it simple for you, but to obfuscate it, what do? You don't just buy one thing. You have
you have like 30 monkey pictures. I understand. Okay.
Yeah, but some of them are actually bought by legitimate investors because they see other people buying them up. You're a prolific seller and buyer of NFTs. Yeah, at that point, it becomes a lot harder to determine
At
what's
this
fraud
point,
and
it
what's
seems like
not
it'd just
fraud.
be easier to earn the money legitimately. I'm sorry. I understand what you're saying. I understand.
I feel
just-
like you don't understand, and it makes me sad. That you can't
No, I
see this.
understand. You're just like, you're like 72 years old cashing out the final monkey picture. And you're like, I finally did it. I finally got my
monkeys are a
illegal
tool.
cash.
The monkeys are a tool that you use, okay? They are a tool
Yeah.
for you. Okay, the monkeys have value, but they have value because you made them have value. You memed them into existence. Do you understand?
It's like Breaking Bad, except seasons 4 and 5 are Walt like actually being a gas station owner, and he's trying to go to war with like the fellow like fuel salesman across the street. I'm sorry. I understand what you're saying. Okay, I get it.
But this is a large amount of it. Of like, I'm not. There's a few that aren't that case. Like the people who sell the quote unquote apes, right? Those are like the that one's pretty standard. But everything else that's not that is very suspect. Okay, it's very suspect, and you have to keep in mind.
Get out of my head. Sorry, go ahead.
Aside from I'm trying to hide where I got my illicit gains. Okay, and I think that's important to know that is a huge problem. If you deal with selling drugs, or if you deal with stealing Bitcoin from people, like, you know, maybe I put a fucking virus on your computer, or I put a virus on your computer until you pay me 10 Bitcoins, I'm not going to unlock it. That's a very big part of the cryptocurrency economy, okay? And you need a way to not only reliably cash that out, but to do it so that if it ever somehow did get traced back to you, like that Tumblr you're using had a backdoor in it or something along those lines, that you now have an extra layer of plausibility because you're a prolific buyer and seller of NFTs on a market. So there's that. But more importantly than that, you have the ability as a seller and creator of NFTs is I can go and I can create a series of 100 whatever NFTs. And if I'm able to sell 90 of them for $1 million, if I came up to you, Steven, and I said, hey, listen, I'm an NFT seller and I've sold 90 for $1 million. I got the remaining 10. How'd you like to buy one for 10 grand? Would you do it? The answer, well, fuck yeah, of course you could. And you'd be stupid not to. I would do that because I would turn around and sell that for 800,000 or whatever. So you've created money out of nothing.
Gotcha. Okay.
I don't like it when you speak to me like that.
It means like I understand. No, I understand. I get it. I totally am on board with this. When are we doing it? I understand, Dan. I'm getting it, okay?
I feel like...
Chat, all of chat is getting it. They're all pogging you, okay? Put ones in chat if you understand what Dan is saying. Okay?
I don't need to be placated.
No, they're going to say ones. There's going to be so many ones, Dan. Everybody gets it.
Oh, my God.
Everybody gets it, Dan. Look, they get it.
Okay. Great. Just...
Can I interest you in an NFT? It's me pogging at the Rittenhouse verdict. Just kidding. Oh my God! Did you see Rittenhouse saying that he wanted to sell an NFT?
Yeah.
Do you know what would it? What?
I said, you know what it would be, right?
Wait.
NFT?
Oh my God! What would it be?
There's two really good ones that it could be.
There's one that would blow. Like it would be a scumbag shit, but it would be so funny. What are you thinking?
I think there's two that it could be. So the first one I think it could be is, you know, that iMessage thing that they're complaining about, the low resolution? Like, is this Kyle Rittenhouse? Yeah. So there's that one.
Okay.
And then it's the iconic photo of him on the ground with one knee down with the blue gloves.
Yeah, okay. I wasn't thinking that. I was thinking a little bit more memey. So Kyle, well, I don't know if he did, but he said he was going to do something that I thought was pretty cool. Was after the court case, he said that he was going to get rid of the gun. He didn't want it to be like a prop or anything. He didn't want, because did you hear that Trayvon Martin, who's the guy that killed him? Zimmerman. Apparently Zimmerman like sold the gun that he used to shoot Trayvon or whatever.
Yeah.
Kind of fucked up. It would be funny if he minted an NFT image of the rifle before he destroyed it and sold that.
I don't know if that would be funny. That would be fucking tragic. Oh my God. You're so fucked.
It would be so horrible, but it would be like so creative.
Oh my God.
Okay. All right. Sorry.
Okay. Yeah. Wow. All right. Well, that was that. I'll let you. Let you get back to.
I feel like I'm prepared to clean some money now. Okay. If I ever come across some illicit funds, Dan, if you see me wheeling and dealing, hey, maybe that's why I took that Eternal sponsor. Maybe all of those mythic NFTs were actually me trying to cash out on some crazy drug shit I did a while ago. Who knows?
I mean, it's all fucking like so stupid. If you'll eat the fees, like you can literally find a bigger sucker. Like, I mean, it's so smart, but it takes so much money to do it. If I had $1 million, I go create a new NFT sponsorship. I take that, fucking
you have $1 million. Just do it.
Yeah, no, but no, hold on. I'm saying I take that Chairs guy who does all like the art for DGG. I get him. We make a series of 100 fucking DGG NFTs. Okay, not even DGG, but just like cool things, a new series. And I buy all of them, right? And I make it look like they're coming from different accounts, but I buy all of them for between, $5,000 and $25,000. I buy all of them, right? And then I start buying and selling them between my accounts. Then I just stop, and then people start trying to buy them from you, and it's all 100%.
And then you wait for the external money. Yeah.
Yeah. No,
something that I thought about
all of them.
to like scam my fan base would be really funny is imagine if we like go through the internet and I'm like, I could present this as like real, like organic, like I haven't thought about this, and I'm like, and I pose a question to my audience, like, do you think it's possible that if we're a big enough size, I'll do it on a politics stage, so I got 10,000 viewers, right? Do you think that we could cause an actual substantial movement in a shitcoin that trades like over the counter for like 2 cents? Do you think we could bump the price of this up to like 5 or 6 cents, or maybe even 10 cents, just for like a day?
Shitcoin?
Yeah, some shit like that. If there was
for sure.
Yeah. And the funny thing would be is if we found one, I was like, I'm curious if we could do this. And we all buy like $5 or some shit, or $1 to $5. And the price actually moves from like 2 cents to like 5 cents or 20 cents, even if it's just for like an hour. That would be super funny. But the thing would be is that if prior to this, if I would have bought like $10,000 of the coin like a month or two earlier, and then they bump it up and I like cash that out at like 10x the price, that would be fucking amazing. But I don't know if that would be it. It would be a fun thought experiment.
For shit like that, like I don't know where SEC rules and shit like that. Like, because
I don't
normally
think any of that is yeah. Normally you could, but I don't think any of the like weird coin shit. I don't think any of that is regulated.
Yeah, that's why it's so fucking crazy. But did you see Biden apparently is getting ready to do some fucking crazy shit? Where is it? I posted it in my Discord. Hold on. Here it is. I'm gonna send you the link. I don't know what this is, but this could be bad news bears right here for crypto people.
Wait, hold on. Hello?
Hello?
I'm not talking to you.
Can you come help me? Help,
Help you with what?
please. My shit's down in the military tunnels. I share the loot. Help. Help.
Are you serious?
Yes, I'm serious. Please.
Bro, it's fucking nighttime.
Get a flashlight.
Oh my, all I have, okay, hold on. I'm about to get fucking scammed. Okay, sorry. Go ahead, keep talking.
No, I was just saying that, Biden apparently is getting ready to issue some fucking crazy shit. And here's the one thing I want to put out to all of my NFT traders, my Bitcoin. Well, no one in this chat's doing Bitcoin. Let's be real. You guys are all Ethereum or something. You don't have enough money for Bitcoin. Okay, listen, guys. I want you to be very careful getting into this shit, okay? Because a lot of you guys are going to be like, no, the United States, the government, they can't shut down Bitcoin. They can't shut it down. It's decentralized. They can't do it even if they wanted to. Let me tell you something. You're wrong, okay? Because they don't have to shut down Bitcoin as a network. They only have to do one thing. And that one thing is make the exchanges that operate in the United States that let you get dollars, make them not able to do what they're able to do, okay? That's the end of it. I'm telling you right now, if you guys can't take your Bitcoin and turn it into a fucking dollar, the value of it is gonna fucking tumble. I don't give a shit if you can still get it in Indonesia or Russia or wherever it is. If you can't get a fucking dollar out of your Bitcoin anymore, okay, and the only way to do it is to find some like crazy guy on local Bitcoins and do it, you are going to get fucked, okay? That's what's gonna happen. And that probably is what's going to happen eventually. We'll see.
I mean, that's essentially what happened to poker, right? Like, I think you can still play poker legally in the U.S. It's just you weren't allowed to operate, like, the transaction part of it, right? That's what basically sunk it all.
Well, yeah, and essentially, like, if there was a stock market attached to the value of playing poker in the U.S., it would have fucking plummeted overnight. Like, yeah, technically you can still do it, but it's just fucking worthless.
Okay,
now,
hold on. I have to talk to this guy. Give me a minute. 1 second.
Yeah.
Okay, what are we doing?
We're going inside the military tunnels.
All right, go home, Steve.
Yeah, I am. Okay, back to the video.
Sale triggered a media frenzy and an online gold rush as various minor internet celebrities raced to cash in on the trend, hoping to be the next to cash out big. Over the course of about 6 weeks, the ecosystem burnt through just about every relevant meme possible. Lena Morris, popularized on Reddit as overly attached girlfriend, sold the original screen grab to Emirati music producer Farzan Fard for the equivalent of a little over $400,000 US. Zoe Roth, aka Disaster Girl, sold the NFT of the original Disaster Girl photograph to Fard for also $400,000. Kyle Craven sold the original Bad Luck Brian photo for $36,000 to anonymous buyer at A. Nyan Cat sold for almost $600,000 with multiple variants also selling for 6 figures. Alice at Harvard sold Creepy Chan 1 and 2 for $67,000 and $83,000 respectively, also both to Fard. In addition to these high-profile sales of things that were already popular, whale buyers like Fard were dropping 4- and 5-figure sales onto a random assortment of other artworks. Corporations and individuals auctioned off NFTs representing intangible, non-transferable concepts like the first tweet or the first text message. Cryptocurrency evangelists jumped at every opportunity to proselytize this new, bold, revolutionary marketplace that would free artists from the yoke of the gig economy and provide buyers with an immutable record of ownership of authenticated artwork stored on an eternal distributed machine. You could be holding the next generation's Picasso. Artists could continue to earn passive revenue from secondary sales. Imagine what it'll be worth in 5 years. This created an air of absolute mania, as it seemed like anything could be the golden ticket. Digital artists, especially those working with media like generative art that's difficult to monetize via conventional channels like physical prints, raced into the space and, on the whole, lost a lot of money. Critics began questioning what it was that was actually being bought and sold. Copyright, commercial permission, a digital file, bragging rights? In a huge number of cases, the answer wasn't very clear, and even the sellers, caught in the promise of a payday, weren't altogether sure what they had even sold. Tons of the tokens did little more than point to images stored on normal servers readily accessible via HTTP, meaning the bought assets would be just as vulnerable to link rot as anything else. Some pointed to images stored on peer-to-peer IPFS servers, which are more resistant to link rot, as, similar to a torrent, it only requires that someone keep the file active somewhere rather than requiring the original server to stay up, but as millions of dead torrents prove, that's still a far cry from the eternal storage solution that evangelists were claiming. The images were stored and delivered the same way as any other image on the internet, easily saved or duplicated simply by virtue of the fact that in order for your computer to display an image, it needs to download it. Claims of digital scarcity apply only to the token itself, not the thing the token signified. More than that, there was no cryptographic relationship between the image and the tokens. The image associated with a token could be easily altered or replaced if the person with access to the server that the image was hosted on just changed file names, making the relationship between the two tenuous and flimsy in a way that undermined the claims that this was somehow a more durable, reliable way of transacting digital art. There was also no root proof of authenticity, no confirmation that the person minting the artwork was the person who created the artwork. This is a pretty handy encapsulation of the way that blockchain fails to solve the most common problems with fraud, which tend to start with bad data going into a system at the input, not data being altered midstream. Artists who complained about this system, which clearly incentivized impersonating popular artists, including deceased artists, were told that it was their fault for not jumping in sooner, that if they had bought in and minted their stuff first, then it would have been easy to prove the forgeries. Because evangelists don't see this as a tool, as a market that may or may not fit into an artist's business, they see it as the future. So failure to participate isn't a business decision, it's just a mistake. They're terrible people. All told, the frenzy collapsed pretty quickly. By June, the market had already receded by about 90%, which incidentally just further incentivized the low-effort process of minting other people's artwork to the point that art platform DeviantArt implemented an extremely well-received feature that scans several popular NFT marketplaces for matching images. The output of that is extremely depressing. Not to labor the point, but reposting digital art without attribution is nothing new. Profiting off someone else's art is also nothing new. All that's new is NFTs represent a high-energy marketplace with an irrational pricing culture where the main buyer is easily flattered and not particularly discerning. The potential payoff is extremely high, much, much higher than a bootleg Redbubble store. The consequences border on non-existent, and the market is clearly in an untenable state, so there's an incentive to get in at as low a cost as possible before it collapses. Hence, the absolute plague of art theft. Even the argument that artists could make passive revenue off secondary sales turned out to have a lot of caveats attached. One, the smart contract for the token needs to have a function that defines royalties, so anyone who minted a token based off of hype, making it sound like an inherent function of the system, was out of luck. And two, the token doesn't know what a sale is and can't differentiate between being sold and being transferred. So it's actually the marketplace that informs the token you're being sold and collects the royalties. End result, royalties are easily bypassed simply by using a marketplace that doesn't collect royalties, or uses a different format of royalty collection that's incompatible with the function the token uses. While a few sellers, legitimate and otherwise, made off with undeniably big paydays, hundreds of thousands of artists bought in only to find that there wasn't a new, revolutionary, highly trafficked audience of digital art collectors. Instead, there was a closed market, dealing in casino chips, where the primary winners were those already connected, who already had the means to get the attention of the whales in the media, a market where participation required buying into a cryptocurrency at a rapidly fluctuating price in order to pay the minting costs to post the work where it would sit unsold. This left those artists in the lurch, where they had to choose between just eating the losses or attempting to convince their existing audience to buy in as well. The people who actually won were the people with large holdings of cryptocurrency, specifically Ethereum, which mediated the vast majority of these big ticket purchases. David Gerard, author of Attack of the 50-Foot Blockchain, summarized it on his blog very succinctly as such. NFTs are entirely for the benefit of the crypto grifters. The only purpose the artists serve is as aspiring suckers to pump the concept of crypto, and of course to buy cryptocurrency to pay for minting NFTs. Sometimes the artist gets some crumbs to keep them pumping the concept of crypto. The rush benefits them in two ways. First, the price of Ether itself goes up directly from the spike in demand. Between January and May, the price of Ether rose from $700 to $4,000. And second, there's new actual buyers who aren't just trading Bitcoin for Tether for Ether and back again, but are buying in with dollars, providing the whole system with the liquidity needed for whales to actually cash out. This arrangement, needing to buy a highly volatile coin from people who paid far, far less for it in order to participate in a market that they control, is why people reflexively describe the whole arrangement as a scam. If you buy in at $4,000 and compete against people who bought in at $4, you're the sucker. It reveals the basic truth that these aren't marketplaces, they're casinos. And indeed, even through all the rhetoric of protecting artists and whatnot, was the ever-present specter of the gamble. Whatever you buy now might be worth hundreds of times more later. Constantly invoked as the opposite proposition of the bad deal. What if you had been the person who bought in at $4? Let's take a closer look at that eye-watering $69 million Beeple sale. Independent journalist Amy Castor has done an enviable job running down the details here in her piece, Metakovan, the mystery Beeple art buyer and his NFT DeFi scheme. But to summarize the long and short of her notes, the buyer is a crypto entrepreneur named Vignesh Sundaresan who purchased the piece to boost the reputation and value of his own crypto investment scheme, Metapurse, and Metapurse's own token, B20, which Beeple owns 2% of the total supply of. Following the Christie's sale, the reported value of B20 went from 36 cents per token to $23. And that's just the anatomy of a single sale. The very obvious conclusion observers reached was that none of this is about the art at all, but the speculative value. Not what it's worth to you, but what it'll potentially be worth in the future to someone else. It's not a market, it's a casino, gambling on the receipt for an image or video that otherwise infinitely digitally replicable. The thing itself is immaterial as long as it can make a line go up. This is the essence of the market and a microcosm of what evangelists imagine they want to see as the future, the financialization of everything. The frenzied market around old Reddit memes was doomed from the start. There's a finite supply of meaningful originals, so to keep this thing going, to keep the line going up, you need something more. Something less tied to anything specific.
Sir, the Lambo's ready.
What?
In the months since the initial craze, the marketplace had mutated. The it thing was no longer memes or digital works from established artists, but character profiles from large, procedurally generated collections with names like CryptoPunks, Bored Ape Yacht Club, Lazy Lions, Cool Cats, Ether Gals, Gator World, Baby Llama Club, Magic Mushroom Club, Rogue Society Bot, and Crypto Chicks. These were notable for, again, commanding utterly irrational prices, seemingly completely decoupled from any legitimate or legal transaction, and being generally extremely fugly. This surge generated an immediately adversarial relationship between the buyers, who touted them as both evidence of their extravagant wealth and their foresight into the future of digital economies, and pretty much everyone else. A very common response to anyone using one of these profile pics or bragging about their purchase became saving and reposting the image in reply, or even changing profile pics to match. Spurred by a speculative tweet from Twitter developers suggesting that they were working on an NFT verification system, Twitter users broadly rallied at the opportunity to immediately identify people that it was okay to bully. Tweets from within the cryptosphere started leaking out, things like Santiago Santos tweeting things like NFTs equal identity 2.0. Can't remember the last time I used my pick on the left. Emphasis on physical traits, genetic lottery, prone to bias and prejudice. Identity by choice, unique and digitally scarce, representation of values and beliefs. Of course, what Santiago was leaving out was that he had paid the equivalent of $171,000 US for that profile pic, which probably gives him some incentive to really commit to it as something interesting and special, even though, stripped to the studs, literally all he was describing was using a non-representational image as a profile pic. For about 6 years, my profile on the Dungeons & Dragons forums was a stock photo of a cabbage, so not really breaking new ground here. Greg Eisenberg sat at his computer and decided to bang out, most people who make fun of NFTs own 0 NFTs, have never minted an NFT, have never participated in a community, have never staked their NFT, haven't built on top of an NFT project, have never earned an NFT playing a game, missed out on Bake, Punks, Cool Cats, etc. A chain of logic.
Okay, hold on. Important question, guys. I don't know if I should get a tried and true cheeseburger fries from this Checkers place, which is really good.
Implying that skeptics of the market are just uninformed, sore losers.
Wish Tabor luck to you on iChat DGGL.
Good luck.
Incidents like these lent to the very accurate perception that the loudest voices in NFTs weren't very familiar with internet culture as a whole, weren't terribly smart in general, and were by and large coming at all this from the financial side, further supported by all of them having "tweets are not investment advice" in their Twitter bios. In short, the same people who made and bought Juicero.
What is this?
It's a Juicero.
It also laid bare that the conversations...
Bro, what is a Juicero? Hold on.